Good morning. Welcome to Trading Hour. I'm Reema Tendulkar, with me Surbhi Upadhyay, and it's a changed picture on the mid-cap index. The mid-cap index has taken a turn for the worse. 1.5% gone in the mid-cap index, and the fall has come through only in the last 15 minutes or so. At 10:30, you would have still said maybe the markets are consolidating, but now you've seen the mid-cap index cave in. The advanced decline ratio is well in favor of the losing side. On the index, there is a shade of red, so the Nifty and the Sensex have dipped in the red, though they were holding up in the green for a greater part. But, the color has changed now, and there is some sign of fatigue, which appears to be kicking in, even for the frontline indices.
Absolutely, Reema. We didn't start with the best of global cues. There's risk-off generally across the board on Wall Street. We've seen that play out in many of the Asian markets as well.
It's a 2% fall on Taiwan. It's a 2% fall on Nikkei. The Korean markets are down 1.5%. So Asia is a sea of red.
No, absolutely. So what started off on Wall Street as a bit of a wobble kind of, moved across to Asia. And some of that is now playing out in our markets as well. Anyway, these are markets which are at very elevated levels. So perhaps, you need any excuse to sell off. And then you have the pre-event jitter setting in as well, with the budget just 2 days away now. So anyway, let's track the action on the screen and see what's going on over here. I'll start with the large caps because even here the fall is pretty dramatic. Let's look at a stock like Bajaj Auto, which was always under pressure. But the extent of the decline has gathered momentum in the last 20-odd minutes. That's what's happened. So that's a Bajaj Auto for you. In fact, talking about the biggest Nifty losers, you've got something like a Coal India, Hero Moto, the Adani twins, which are part of the Nifty. Adani Ports and Enterprises, they're tracking some weakness. But like Reema saying, this is a story about the broader market and the huge fall that's playing out over there. So let's see where the money is coming off. PSUs to start off with. And that's little surprise, right? Look at a stock like Railtel, 6% lower, RVNL 5% lower, NHPC 5%, IRFC 4%, Aircon 4%, BEL, BHEL, NALCO. So very, very quickly, there's a sharp sell-off on the PSU side of the market. So hard to say, Reema, what could have triggered it? But I guess this is a market that's just, it's kind of sitting at the edge, looking for reasons to book profit. And perhaps before the budget, this is one of those shakeouts.
Before the budget, next week is also the expiry, the earnings season. You've got a few misses like Asian Paints also. So all that is, compounding, and it's just profit booking that's visible in the broader markets, considering the big triggers that we have. But let's get to IT, because that's the big story. TCS was a better than expected set of numbers. HCL Tech managed to report a modest beat. Now, LTIMindtree is the third large IT company, 3 out of 3, where the numbers have been ahead of street expectations. So LTIMindtree has positively surprised on the top line. It's a 2.5% revenue growth versus estimates of about a 2% revenue growth. BFSI for the company has turned around after 4 quarters of a decline. And BFSI is their largest vertical. So BFSI turning around has helped them put on a good show on the top line. The company has also said that there are some green shoots. So yes, while cost takeouts continue in the market, but at least some of the high transformation projects, the high priority projects which were put on hold in the BFSI vertical have now been resumed, and that helped the company clock in growth. While broadly the demand environment continues to remain unchanged, LTIMindtree has come out and spoken about some green shoots, some high priority transformation projects now getting resumed. Motilal Oswal today has upgraded LTIMindtree to a buy. They believe that the stock will outperform its peers in FY26. Not this year, the following year, the company will be able to report double-digit revenue growth. The only risk is on margins. So that's something you need to watch, the way margins for LTIMindtree pan out from here on. But 7,000 is the target price assigned by Motilal Oswal as they've upgraded the stock to a buy.
That's LTIMindtree. So we talk about happier things as well, right?
Yeah.
Not just everything that's falling in the market. Speaking of happier things, the one earnings reaction that's gone down so well with the street is Just Dial. Let's see what the stock is doing right now. Imagine that in a market where mid-caps are collapsing, it's retaining that 16% up move. Oh, that's something, Reema. So what have they done so right? Definitely dialed the right numbers, dialed the right business, opportunities this quarter.
Well, it's one thing. It's the margins. Very strong showing on the margin, and that single-handedly lifted the stock. Pull up a margin contribution plate. Year on year, margins have doubled from 14% to 28%. Quarter on quarter, margins have improved. Margins are now at the highest level since 2016. And this is on the back of cost optimization, cost reduction efforts that the company has taken. The paid campaign growth has come down, but for the last 3 quarters, it's been between 8 and 9%. So you can say it's been a bit steady. The company is targeting mid-teens revenue growth and EBITDA margins above 25%. The board is also working on a dividend policy. Their endeavor is to return 100% of the profits to the shareholders by way of a dividend. But Ambit says this margin obsession is costing growth. So the collections for the company, the traffic has come down, and that, according to them, is a bit of a red flag. But Just Dial stock is flying high today, 16% up on the back of a very solid, robust margin expansion.
Absolutely, Just Dial definitely standing tall and bright green in an otherwise wobbly market. Well, that's Just Dial. Let's move on and touch base with the management of KC International. Now, this is a company in stock in focus because the company secured orders worth about 1,100 crore rupees in the T&D business in India, in Middle East, Australia, as well as the US. To talk about these orders and the outlook, we have with us Mr. Vimal Kejriwal, MD and CEO at KC International. So good to have you on. And, once again, your order winning spree continues. We keep hearing of orders on a very consistent basis. So let's just talk about, the nature of these orders. All of them are from the T&D segment. And where does it take your total order book to now?
Good morning, Surabhi. I think with this, our order book is now slightly above 30,000, and we have around 7,000 crores of L1. So it's around 37,000. It has been at that level for some time. That's where we are.
Have you seen a pickup in the kind of order wins or the order announcements? Has there been, any change in the way the tendering and the awards have been on the ordering front? Because back-to-back big wins for you.
So, Rima, some part of it is because of the backlog which we had because of the elections and the Achar Sanhita. So, April, May, many of the tenders where we were L1 were not awarded. So some part is flow coming out of that. But the good part is we are seeing a lot of orders coming out of UAE. UAE had been a laggard for last, 3 or 4 years, whereas it was one of our biggest markets in the international. Now, suddenly we have started seeing orders coming in. This is the third or fourth order this year we announced from UAE. And the next one is the Australia piece. Australia, again, there's a huge transmission work happening. We don't do EPC, we only do supplies. And we have got a lot of inquiries and tenders there. So clearly we are seeing a sharp uptick in the T&D part of the business.
What has changed in UAE right now versus what was happening in the past 3 or 4 years to explain this pickup in interest? And how much does UAE contribute to your revenues or by way of your overall order wins?
So I don't have a separate figure for UAE, but between UAE and Saudi, we have around 12% of our order book is from the MENA region.
And what has changed? Because you said that there has been a sudden pickup compared to what it was.
I think one is the general uptick which is happening in the Gulf region. And secondly, most of these orders are actually in the oil and gas part of it. It's not oil and gas. We don't do that part, but we are doing the power supply and all to the oil and gas region. So basically for ADNOC, etc. We are also seeing some tenders and orders coming in from Dubai, which are more related to the new real estate development, let's say Nakheel and others and all. So I think clearly we are seeing the mood in UAE seems to be upbeat both in Dubai and Abu Dhabi.
Okay. I missed that number, Mr. Kejriwal. What's the split between your Middle East business and the India business now?
I don't have a direct answer for that. But what I said was our Middle East was around 12% of our total order book, whereas T&D by itself is 50% of our order book. So that's the way the number is.
Okay, that's how you stack it up. Now, going back to the headline number, which is your current order book with these orders is at 31,000 crores. That sort of gives you revenue visibility over how long? Typically, an order book of this size, this is to be executed over what, next 2 years, 3 years?
So typically, this will give us around, 6 quarters. Okay, because most of our orders, 6 quarters. Most of our orders are around 18 months to 24 months. Okay. But more on 18 months, I'll say. India orders, most of them are between 15 to 18 months. Okay. So six quarters is what I'll say.
And in this order book, in terms of the product mix or rather the project profile, the order profile, how much is it now orders which are coming in at higher margin levels, and what kind of orders are those, and therefore what should we expect, for the end of the year? What should be the margin profile? I'm talking about the overall business now.
So to me, I think all of them are now coming at higher margin. Okay, to be very honest, because we have an order book, we are seeing a tender pipeline of almost 1,38,000 crores today. So there is no reason for me, unless it's absolutely strategic, to take a project now at a lower margin. And coming to the margin profile, we have generally been maintaining that our year-end exit margin should be anywhere between 9 to 10% is what we have been talking, and I think we are confident that that is what will happen.
9 to 10% exit margins for FY25.
Yeah.
Got it? All right, sounds good. And it's very clear that business is good for you. Thank you very much, Mr. Kejriwal. We'll leave it on that note for today. Appreciate you joining in and giving us some more perspective on the business. It's KC. International stock has been doing well, but it's cooled off because the overall market, especially mid-caps, are in a bit of a fall. But KC is still retaining a gain of 2.5%. Take a break, come back on the other side, and we will get you excerpts from our exclusive conversation with Chris Wood. Welcome back. Let's now get you an exclusive. Energy is a hedge against geopolitical risk. That's the word coming in from Jefferies' Chris Wood as he visited the CNBC-TV18 studios for a town hall on the markets with some of the biggest market stalwarts in audience, including Ramesh Damani, Utpal Sheth and Ravi Dharamshi. In an hour-long session, Chris Wood gave his take on local money, valuations and his preferred themes in India.
I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could... I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return dividends. They're defensive, but they could be like tobacco stocks. Tobacco stocks the last 20 years have been good performers. The defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks. But the problem in India is what not to own.
Right.
So my portfolio has been basically built on the... where the performance of my green and fair portfolios come from the last year, I would say in property, energy and infrastructure, but the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict, maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
Yeah. And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector. The foreigners are remarkably underinvested in India. So we believe that the global emerging market funds, who are the prime investors in Indian equities, are barely neutral in India, partly because the neutral weighting of India has gone up because it's outperformed, and partly because they haven't really been able to get into the market because the local money has kept it at valuations where they're not comfortable with. But there's another point. Most foreign portfolios are still strongly influenced by what I would call legacy positions because they have big holdings historically in IT services and banks, which are a big part of the traditionally of the MSCI India index. And while these are perfectly okay stories, they've not been where the performance has really been coming from. So what we're seeing is foreigners gradually capitulating and reducing the holdings in banks and IT services and adding to these hotter areas. But, they're basically behind the curve.
Okay, there was a very interesting chat over there. We need to slip into a very short break. We'll come back and put the spotlight on some buzzing stocks. Stay tuned. Welcome back. Z Entertainment shares slip after the board approves the issuance of 10-year foreign currency convertible bonds worth $239 million. Manglam joins in with the details. Manglam.
Well, the reason why the stock is lower is largely, there are two reasons. One is that the company was hoping for some sort of strategic investor to come in when it comes to the money. And the second part is that even though it is a convertible, issue, so the fact that there is money coming in is a mild positive, but this money is coming in the form of foreign currencies. So that, puts it to that risk, the foreign currency risk. Importantly, initially it would be treated as debt on their books. So has a bit of a dent on their balance sheet as well. But once it converts at around 160 rupees per share, it would lead to massive dilution of almost 11-12% of their current equity post-money. And as a result of which, what happens to the promoter stake as well, which stands at a measly 4% right now, that gets further diluted as well. So the street would have actually liked some sort of strategic investor coming in the form of fund addition to Z, as against them raising funds via FCCBs, and that's exactly is the major concern out there. The Z stock has been on a downtrend ever since the deal with Sony was called off. The street was hoping for some sort of corporate announcement in the interim, but the fact that there has been a bit of a stopgap fundraise arrangement that has come in, which may in the very near term dent their balance sheet and over the medium to long term lead to dilution of share capital, has the stock lower in today's trading session.
Okay, all right, Manglam got it. So Z once again in a bit of investors' crosshairs with this move on the FCCB front. Thanks for joining in. 143 on Z right now. By the way, speaking of Z, the overall decline in the market, that continues as well. Not much change. 900 points gone from the mid-cap index. The Nifty is down about 66 points, and the Bank Nifty is also losing about 100 right now. So things are on a bit of a slippery slope, so to speak. On the large cap screen, two-wheeler makers, Bajaj and Hero, both of them are seeing plenty of profit-taking. That's the shape of things right now. And what is standing tall once again is IT. Look at TCS right on top, 2.5%, which is up and about. Infosys is up about 0.5% as well. Speaking of Infosys, of course, it's all eyes on this tech titan now. Rima, I think with TCS and even with HCL Tech, the expectations are only rising. Yeah. What about Infosys? What do the consensus estimates look like?
I think you want Infosys to come out and echo that there are some green shoots, right? Keep the hope alive that there is a turnaround in sight at some point, maybe towards the end of the year. Because while, TCS, HCL Tech did report better than expected numbers, their commentary, actually all the commentaries are not suggesting that there is a broad pickup in demand.
They're saying the environment is the same.
The environment is the same, but, for instance, now LTI Mindtree spoke about some green shoots, some of the high transformation, high priority projects in the banking vertical getting resumed. These were projects which were put on hold last year when things got tough. And now some of those paused projects are coming back on stream, right? So those are the small green shoots. HCL Tech also saw some small green shoots. So you want Infosys, that big giant, to come out and say the same thing, right? That, otherwise, it may spoil the party, or, the street will again be a little unconvinced.
And Infosys, if I remember correctly, was actually very cautious, even more cautious than TCS, even in the previous quarters.
So Q4 was a very weak quarter for Infosys. Their guidance was very subdued for FY25. And here, analysts said that maybe they're being too cautious in their guidance. And that's because in FY24, they had to keep revising their guidance lower, twice or thrice. So they didn't want to do that. So they've said that there is no pickup in discretionary demand through the year. So the guidance was, fairly muted. But let's quickly get to, what the numbers that we're watching out for. Well, top line growth seen at about 2.5%, as you can see. This will be ahead of what peers have reported. You add an LTI Mindtree there. LTI Mindtree clocked in about a 2.6% top line growth. Infy's growth will be driven by ramp up of previously won deals, and there was a reversal. There was an impact of 100 basis points in the prior quarter, which pulled down Q4. So the absence of that will push up the growth. Margins are seen up by 60 basis points to 20.6%. No wage hike impact for Infosys this time. So a top line growth, no wage hike impact pushes their margins up, driving a 3.5% increase in the profitability. Expect the company to maintain its full year guidance of 1 to 3% on the top line and margins of 20 to 22%. But as I said, it's the commentary and whether there are some green shoots. No company is going to come out so early and say that, yeah, things have picked up and now the picture is very rosy. But you want to hear the word green shoots, some early signs of a recovery. That's the performance in the month of July, up close to about 10%. Let's get into a break on that note. We'll come back, discuss market fundamentals. Mukul Kochar of Investec Capital Services joins in on the other side. Welcome back. Let's get to the market and the way forward. Mukul Kochar from Investec Capital Services is now with us on the show. Mukul, thank you very much for joining in. I remember our last conversation was just prior to the election verdict day, or a couple of days prior to that, and we were discussing what happens, the various scenarios. Well, since that's played out, we've seen the market skyrocket from levels of 22,300. We're now at 24,500 plus. It's just in the last few days, markets appear to be consolidating. What's the call now? What's the strategy? How are you seeing the setup?
Thanks a lot for having me, Rima. So, election was what it was, right? So it's firmly behind. The good thing is that we have some continuity, and the government is, messaging that continuity. So that's at least, positive for the markets. Now, going forward, therefore, most of our calls remain the same. We have been running three themes prior to the elections. Actually, since last year, we continue running those. One is we believe that we will get into a current account surplus situation, which has implications both for growth and the currency. The second is we believe that there will be a strong private capex cycle over the next few years, which is derived from our analysis of very, very strong and solid corporate earnings and a substantial gap between earnings and current capex. We believe that capex will move towards corporate earnings as it has in the past. And third is our call on discretionary consumption, which honestly, that's probably one thing that changes with elections, where we think the discretionary consumption will come out fast. So our portfolio construction is around this. We believe earnings growth will follow a formula of roughly 10-11% earnings growth, a little bit of margin expansion with roughly 14 to 15% PAT growth. So the market seems pretty okay. There is fluff. There are concerns brewing a little bit on the horizon as well. But sector-wise, if you do sector selection, I think you should be okay in the market.
So just particularly on that theme of consumer discretionary, well, some pockets of it are showing some signs of weakness. Titan, for instance, for 2 quarters now, even their current guidance is talking about pressure. Asian Paints, this is the second quarter where we've seen a decline in their, revenues. So is there some stress emerging, at least in pockets of consumer discretionary?
Yeah. These are specific stories as well. While I won't delve into a call on specific stocks because compliance restricts me, but if you look at some of these stories, competition is really hitting hard. There are new entrants, and the companies have had to repivot, themselves to, face up with those new entrants. And honestly, some of these stories will be structurally challenged, and people will rethink the kind of multiples that they've given them in the past. Having said that, if you look at the auto sector, which is what we're really, really bullish on, the entry valuation is not so aggressive, was not so aggressive. Some of these companies have posted very, very solid numbers, which honestly led our analysts to upgrade earnings on report. And that's where we will focus more. I think the auto sector is really, really well positioned as a consumer discretionary place. Some of these, other stories that you mentioned may have some dynamics going around with new competition coming into the sector.
Mukul, hi. So where is IT in the scheme of things? Good to have you on the show. So just wanting to understand where IT is in your overall scheme of things, because this is the first time that we're not seeing disappointment from many of the companies. At least the commentary is not as bearish, numbers are not as bad. Don't want to jinx it. Let's see what Infosys says today. But most portfolios either are underweight or neutral on IT. What would your recommendation be, looking at the way things are shaping up now?
You actually sort of said it very well. Lack of disappointment and sector rotation and the sector ripping. Having said that, it's still a sub 10% revenue growth sector. Especially when you look at it in the context of our call on, the rupee, we think current account is going to sort of become surplus. Secondly, if you look at where the US is going, there is already concern around the economy. Calls for, reduction in Fed rate, which had gone on the back burner. They're back in. Those are things that you have to consider when you consider investing in IT services. These are not, even if you look at the margin going forward, we are already projecting, street estimates are already projecting peak margins. So they're 10% or sub 10% growth stories, and you have to consider what multiple you give them. Very, very high quality businesses, but I think they've already sort of reached peak multiple. Lastly, you have to consider what's going to happen to US politics. Last time, the expected dispensation was in power. IT sector was a big bargaining pawn for trade concessions, and I firmly expect that those discussions will be back on the plate next year. So if you're slightly forward-looking, at least even 6 months, I wouldn't be piling into the sector now.
A quick word on banks, where we're getting some mixed views. Some believe the peak performance is behind them. Others believe it's gone through a long period of time correction. It's got to perform. If India is doing well, how can the Indian banks not shine? So where do you stand on banks?
Yeah, banks, I'm very constructive. Of course, there's some specific stories, and you have to be careful in stock picking. I have, on the asset quality, if you look at the corporate side, really, really sound. Consumer, we are saying, is probably going to get better post-COVID hits that the consumer took. Credit growth has picked up. Formal job creation, I think, will pick up as well. And finally, on valuations, right? This is one sector where I don't sort of see stretched valuations at all. So banking, very positive. Going forward, it's also a large sector which allows us to remain constructive on the market overall as well.
All right, fair enough. Got it, Mukul. Thank you very much. Appreciate the views, and thank you so much for joining us today. But with that, we do have to take another quick break. We will come back on the other side with a really interesting story. SEBI is looking at allowing asset managers to now come up with a brand new asset class, something that will sit in between mutual funds, plain vanilla funds, and PMS, portfolio management services. What does this mean? What does the consultation paper say? And what's the industry's reaction? We'll ask Mr. DP Singh, Deputy Managing Director and Joint CEO at SBI Mutual Fund. Welcome back. You're with us on Trading Hour. SEBI is now proposing that asset managers set up a brand new asset class. I'm not making this up. It's really called a new asset class in the new consultation paper that SEBI put forth. Now, what is this all about? Basically, SEBI is saying that maybe it's time for the market to evolve and for a product that can sit in between plain vanilla mutual funds as well as portfolio management services. PMS, of course, the threshold is 50 lakhs. For this new asset class that's being proposed, the threshold for ordinary investors will be much lower, as low as 10 lakh rupees. The idea is that perhaps the market can have a product which has a slightly higher, superior risk-adjusted return profile. How will this work, and what is the industry's feedback on it? Well, let's discuss this with Mr. DP Singh, Deputy Managing Director and Joint CEO of SBI Mutual Fund. Mr. Singh, always a pleasure to have you in the studio, and there's so much to talk about today. We thought we'll talk to you about budget expectations, but then SEBI is always offering something new and exciting, right? So let's start with this first. I mean, the concept of having a brand new asset class, a new product altogether. What's your first take?
Yeah, thank you, Sarvay. Thank you very much for having me on the show. And honestly speaking, we are also excited to have a consultation paper on this asset class, because we strongly feel that there's a niche of investors who are actually ready to take a little higher risk, but SEBI feels that they still need some regulatory platform which is lighter than the mutual fund regulations, but it's little tighter than the PMS regulations. Today, the PMS regulations are very loosely then, so that because the idea is that anybody who's putting more than 50 lakh rupees is really an evolved investor, and he knows about his risk appetite, about the and the risk taking capabilities also more. But this 10 lakh to 50 lakh is a class which has become 10 lakhs over the period of time with the mark to market also, and they are ready to take higher risks. So that's a very, very welcome step by SEBI. Because today we cannot do derivatives or anything which we can use derivatives in mutual fund platform only for the hedging purposes. But as a strategy, the long short kind of fund and having a call working on behalf of investors as an aggregator and giving them some better return on the basis of the skill set which is already there in mutual funds. So that's something I think will be able to create good value for the investor in the times to come. But since yeah.
So allow me to actually focus on that first. I don't think the eligibility criteria will be an issue for most, asset management companies because it's 3 years of existence and average AUM of 10,000.
That's not
a concern. A lot of managers will meet that, so that's fine.
Yeah.
Let's focus on some of the things that this consultation paper is speaking about. For instance, exposure to derivatives. It's saying that the exposure is going to be allowed for purposes other than hedging and rebalancing. But there are certain caps that total exposure to derivatives should not exceed 50% of net assets. Exposure to single stock via derivatives should not exceed 10% of net assets. So just, explain this to us that will this really help offering a product which could potentially have a bit better return profile?
Definitely. See, as I said, the mutual fund platform is such that where the regulations are very, very tight. And that has been kept so because, regulator want that the interests of the investors, especially those who are coming for the first time, are protected to the maximum extent. There should not be any room for mismanagement or mis-selling that the mandate of investor is something and the mutual funds are behaving in a different manner, the manufacturers. To take care of that, now they're saying that there's a big asset class, which is actually true, that over the period of time, over the period of last 4 or 5 years, the surpluses in the hands of investors have gone much higher, and people are ready. The mutual funds are the argument of why can't I do it myself? Why should I come to mutual funds? So on and so forth. But mutual funds, honestly speaking, have a lot of other skill sets, which we are able to showcase also in PMSs and other classes. For example, if I talk about the long short fund, we are already having one long short fund which is taking active calls on derivatives. That fund in Gift City is generated 5% alpha by actually investing only 57-58%. So that we are not able to, those kind of things we are not able to offer this thing. Once this consultation paper becomes a reality, and with the kind of, with your question of that they are putting some conditions, that rightly so, that we don't
No, sir, returns. My question, sir, my question, see, at the end of the day, the investor is chasing returns. If an investor is trying to go away from plain vanilla funds, it is in the lure of higher returns, right, elsewhere. And that's what SEBI is looking to now tap into to regularize, regulate, and bring it on board. So every time we talk to you folks and your peers in the industry, we are told that an investor should have a reasonable expectation of, let's say, 12% return on a compounded basis over long periods of time. So realistically, what is the superior return that perhaps you are hoping to bring forth with this new asset class?
But one thing is very clear: the golden dictum of higher risk, high return are coming with higher risks. And this category will take higher risk than the mutual fund normal scheme. So naturally, when we are taking higher risk, with the probability of generating higher returns than the mutual fund scheme returns, that goes along with this. But at the same time, the risks taking also has been limited to an extent which is higher than mutual fund by keeping the limits higher than mutual fund schemes which have been allowed, but not whole hog like in PMS. You can go at any percentage. For example, they have talked about the REITs also. Now, REITs, they have increased the limit. The single issuer limit has been increased to double because that was always an issue. When there are lesser issuers in the market, we were not able to invest in mutual fund scheme. But here we can have a portfolio of 4 issuers also giving higher returns. So naturally, it will be beneficial to the investor. So over the period of time, it will evolve. But the thought process is very, very, honest in this, that has to be something in between PMS and say mutual fund scheme. And of course, 10 lakh rupees is also something where we can't say that you can sell it to absolutely anybody who is coming to the market for first time.
Sure,
So that's also is a golden message. I think that this has been discussed also informally before the consultation paper came up. And this was the demand of the industry. This was the demand of investing community as well. I think
and
it has
now
been
the regulator is opening it up.
Yeah. It's
Okay. All right. I got that. So we just have very few minutes left on the conversation. Before we let you go, because we're running up to the big event, budget expectations from the mutual fund industry. Are you worried about taxation?
I'm really not, because the kind of fiscal situation where we are in and the way government is talking about attracting investments, my wish and hope is that nothing will change. Even if something changes, honestly speaking, people are not putting only money into the investment schemes or investments just because it is having a preferred tax rate. People are putting in money because they want higher return and they want to be part of the growth trajectory of India. So slightly tax changes here or there will not make the market go heavy. That's my firm belief. But my wish and hope, again, I'm saying, I think the things will remain as it is. Nothing will change.
All right. Well, we investors hope so too, at least on the equity long-term capital gain side. Let's see. We'll have our answers in just the next 2 days. Thank you very much for joining in today. Let's take a break. We'll come back with more in just a bit. Well, we are in the last leg of trading hour, and before we wrap up, let's take a look at something important. Building a legacy from the ground up takes vision, perseverance, and the right kind of support. HSBC presents CNBC-TV18 SME Champion Awards, celebrating the encouraging journey of one such incredible Indian entrepreneur, Natural Remedies. But what were the key ingredients that fueled this remarkable growth from a small team to a global exporter? Let's hear directly from Mr. Anurag Agarwal, the Managing Director of Natural Remedies.
My name is Anurag Agarwal, and I am Managing Director at Natural Remedies. Natural Remedies was started by my grandfather and my father way back in early 50s. It's been a wonderful journey. I have completed almost 39 years with Natural Remedies. From an institution with around 25 people, now today we are close to 1,000 people. Today our products are available globally. We are exporting these products more than 30 countries across various continents. And we are proud of our contribution. We have a research center which is approved by Ministry of Science and Technology. Almost 12 to 15% of our growth every year comes from the new introductions. We have divided innovation into categories where there is a separate team which works for the future innovation and a separate team which works on the immediate needs of the organization. Finance support has been available to us from various institutions. Since we are an export-oriented organization, funds have been made available to us through the various government schemes at a very reasonable prices. So we feel deeply supported there. So I can see the changes which are happening, and we are happy with these changes. Today, our international business contributes to close to 30% in our total turnover. We plan to take it to 50% in the next 4 to 5 years. Human evolution is the most critical component to mitigate any risks or changes which are happening in the market. And the better we make ourselves, the more fitter we are to respond to the changes and the difficulties which we may encounter going forward in our life.